Hello, listeners. My name is Raj Singhal, and welcome to another episode of Breaking Investment Stereotypes. This episode is brought to you by Multipie.co, where we believe that investing is an ignored life skill. Our mission is to create a platform where people can come, learn, share, and collaborate through the right tools. Ultimately, we want your hard earned money to work for you. Here at Breaking Investment Stereotypes, my job is to deconstruct world class investors or wealth managers and deep dive into their investing journey professionally, personally, or both. To get into how they've broken these stereotypes in a seemingly complex world of investing. I want to give little guidance on how to use the shows. None of the following should be taken as an investment advice. Please see multipie.co/disclosures for more information. My guest for today is Abhay Pandey, who's a close friend for over 3 decades. Abhay is a founding partner at A91, a venture fund established in 2018. A91 has invested in companies like Sugar Cosmetics, Go Digit Insurance, and Hector Beverages. Prior to founding A91 Partners, Abhay Pandey was managing director at Sequoia Capital from 2008 to 18. At Sequoia, Abhay has partnered with passionate founders in consumer and healthcare sectors, focused on a few themes like creating challenger brands in large categories, supporting superior execution capabilities in massive market opportunities, and or building companies in a new emerging category. Prior to Sequoia Capital, Abhay worked as an investment banker with TSP Merrill Lynch and as a management consultant at McKinsey and Company. Abhay received his MBA from IIM Kolkata and a BTech in computer science and engineering from IIT Bombay. Abhay is passionate about supporting philanthropy and giving back to society in education. He is a trustee at Ashoka University and a trustee of Bhilai Education Charitable Trust, which is doing some good work for primary and secondary education. Please enjoy my conversation with Abhay Pandey. Hey, Abhay, welcome to the podcast.
My pleasure, Singhal.
Yeah, as we know, we grew up together in Bhilai, studied together at IMC, worked together briefly at DSP, been friends for a very long period. But did it ever occur to you that one day you will get a chance to be on my podcast?
No, if you're asking me if I ever thought something like this will happen, no, it's a massive surprise for me. I won't imagine you doing this on the other side or me doing this on the side, but it's a good surprise.
You've done very interesting stuff after education. You had a journey from you joined consulting, then you came to banking, and now you've been in investing for more than a decade now. So how's been the journey like? And do you want to talk about that?
So as I said, when we put our blinkers on in Bhilai during our school days, our only objective was to get into IIT because that was so-called the best thing one could do. From there on, if you did not want to go abroad, the best thing to do in India was to go to IIMs, which is what we all did. We did together. And at IIM in 1996, when we were passing out, the best thing that one could do was consulting because there wasn't much of investment banking. There wasn't much of other things that one could try. So I got into consulting not because I loved it or I knew what it was in store for me, but that was seemed like the best thing to do. But having been a consultant, what you learn is it really teaches you structured problem solving, teamwork, and to get to the right answer or have the focus on the right answer. Doing consulting for a few years, it was clear to me that I wanted to be in the world of finance. And the investing world wasn't really existing in India at that point in time. There may be one or two firms at best. And therefore, it felt like if you get into investment banking, that might be a better route towards getting to the world of investing, which is when I moved into investment banking. Investment banking has a completely different flavor. It's about closing deals. There's a rush, excitement of getting things done, and that's what it teaches you. It's less about teamwork. It's more about closure. It's more about making things happen, getting results on time. And then when the investment world started opening up in India, it was clear to me that I wanted to move onto the investing side. When I got a chance in 2007, when Sequoia was entering in India, and having done consulting investment banking, for the first time with investing, I learned what real ownership of your actions means. Because both in consulting and investment banking, you're really an advisor who gives the best possible advice at that point in time and moves away to the next project, next assignment, and so on. But investing is about owning the consequences of what you do for many, many years. It also teaches you patience, it teaches you relationships, it teaches you thinking very long term. And those are things that I've been learning over the last 13, 14 years at Sequoia and now more recently at A91.
What I hear from you is it's actually a lot more important to know what is the best thing to do right now rather than thinking 10 years, 15 years ahead, because you will end up there at the right place. As you said, you're at IMC, you knew consulting was the best thing to do, or then investment banking, and then when things opened up for investing, you jumped out to that. So it's more important to look at within the immediate next 1 or 2 years rather thinking too long term.
I agree with you. If you think 10 and 15 years out, you actually don't know what the options then might be.
Yeah, true.
And so it's very impossible to plan for that. But if you have some directional sense of where you want to go, you can start aligning your actions in that direction. You can't plan for 10 years, but you can start thinking, hey, if this is what I want to do over the next 10 years, if possible, what is the next best current move that possibly positions me well for that? It may never happen. I think the best thing one can do is put your head down and do the best of what you're currently doing versus thinking too much about what else is happening out there and what would be the best thing I could be doing. Do your job well, do it damn well every day.
Yep.
And if you do that very well, somebody will notice you for the next best thing that's out there for you.
Since you've done investing for 13, 14 years now, let's spend some time in understanding when you look at a company, look at a founder. I mean, you've done a very early stage at Sequoia. You guys doing little late stage here at A91 as what I understand. Basically, we're trying to deconstruct an investing journey. So, let's try and spend some time on that.
So, as you rightly said, at Sequoia, we invested from very early stage to somewhat late stages. And at A91, it's more about what we call early growth or Series B/C companies. But some of the, before diving into the details, I'll just give you some highlight of how at these different stages we think about what's important. And then dive deeper into some aspects of the founders. If you're going into a very early stage company, where usually it's a couple of people with a business plan, or it's a company which has just started selling something but very little revenues, the most important aspect of decision making is the team itself. So you look at the team and you have to decide on the capabilities of the team on whether they can win it or win in the market or not. So team becomes most important. As the big business becomes very large, and that's late stage investing, it's the market which becomes very important. The team gets, well, it's important, but the market defines what you will get, what returns you're likely to make. And somewhere in the middle where we currently operate, which is the early growth stage, you have to take into account both the team and the market. And let me just explain the reasons why. So when you're a very early stage company, a team comes with a plan. It's possible for the team in the early years, first year 1, year 1 to 3, to even pivot the business into different directions. So you may start with an idea, but a year and a half down the line, the actual business may be going in a very different direction. However, as you spend more time, it keeps getting increasingly hard to change the market you operate in, and therefore the market's importance keeps increasing. And as the market keeps dominating, the importance of the team stays, but on a relative basis, the market keeps getting more and more important. And for example, today, if you take investing as an option in a steel company, it's the market that decides the outcome of the company. It's less the management in a very large company. There's a very famous saying which goes around in our business, which is when a good founder meets a bad market, the market wins. When a bad founder meets a good market, again the market wins. And when a good founder meets a good market, that's when magic happens.
Interesting.
And that's what we are all looking for: a good founder meeting a good market. But at a very early stage, sometimes it's not possible to define the market very well because market's also fungible. When Amazon was started, it was a business of selling books. If someone did analysis of how large is the online book market in the US or anywhere else, it would say, hey, it's a small market. Let's not invest in it. But the market expands from books to music to everything else. And similarly, in most companies, when you look at the first market, either it's too small or it's not exciting or the margins don't exist, but as the business expands, the market quality can expand, or good founders find good markets or gravitate towards good markets. So that's the overall thinking behind different stages of investing. Now, you also asked the question around deconstructing investing journey. So an investor's journey. Um, Most importantly, you need to focus on some part of the market. Saying, let's take the example of A91. We say that we are Series B/C investors. What does it mean? It means that we'll invest in any company which has got some real revenues. The real revenues could be $5 million, $10 million, $50 million, but not someone with zero revenues and not someone with $500 million of revenues, because that's very large. So you look at the space of, let's say, $5 to $10 million of revenues to $50, $100 million of revenue. So you have to, our job is to know every company in that stage, or any company that will get into that stage over the next 2-3 years. And you need to be meeting them before they're ready to fundraise. So our job is to, one, look at every company that has raised any money in India in the last 3-4 years, because that's coming into our window. So make sure that you're meeting these companies, you know who they are, they know who you are, you have some sort of relationship, and you have a point of view on the company, because this will be a relevant investment set in the next 1 to 3 years. So meet every company, just be aware of their business, have a point of view on the business and what you need to see when you meet them next in 3 or 6 months. So that's step one. Second, there are also many companies that emerge that have never raised capital. Sometimes bootstrap companies get to 5, 10, 15, $20 million of revenues without a single dollar from outside. Those are the harder ones to track. Because the ones that I invested in, it's on the website of some fund and we know all the funds and it's easy to track. The companies that are growing up in Indore, for example, never raised capital, how do you track them? The only way is having a top-down sector focus, saying my sectors of interest are A, B, C, D. In these sectors, I'll deep dive and break it down into subsector A1, A2, A3, A4. I'll take each A1, A2, A3, A4 and dive deeper and say, what are all the companies that exist which have revenues of 5 million to 550 million, and make sure that I have reached out to them by cold calling them and figuring out about their business and understanding their business and making sure that they know who we are and what we can do for them. And then being in touch and to figure out whether there's an appropriate time when there's a chance of making an investment. So these are the two ways in which we source what you call investment opportunities. The first one is relatively simpler. It's more competitive because everyone is seeing those and everyone is jumping and pouncing on the same companies with higher and higher valuation because that data is obvious. On the other one, which is the harder one, you keep a track of industries of your area of interest. For that, you have to go to industry conferences, you have to talk to experts, you have to talk to professionals in the industry saying who's your competition, which companies are doing well, talk to consumers, walk the supermarket aisles, look at what products and services are selling, etc. So keep doing different things to figure out what may be taking off. Look at online signals, who's recruiting more on LinkedIn, which companies are being spoken more of in social media, what is featuring more in Instagram, etc. So do many such filters to identify the companies that are shooting up in importance. So we do these things, and then after that, there's an active pipeline that you maintain all the time, saying here are the next 20, 25 companies that are of interest, which we will track over the next, which are likely to be our investment opportunities. So at any point in time, for a fund like us, you will have a set of 20, 25 companies that are priority. And within all of them, you're trying to create some investment opportunities. And some will just fall away because somebody else comes and pays a much higher value. Some will fall away because you suddenly go deeper and realize that things are not stacking up as well as you thought they are. And some of them will decide not to raise money at your point in time when you are interested. And therefore, a few are left behind. We need to make 4 or 5 investments a year. And from this set, you find your 4 or 5 opportunities in a year. If you go early to the venture side, it's a lot harder because their companies are coming up every single day. Multiple companies are coming up every single day. And therefore, you need to be a lot sharper on online versus offline. So you need to be actually scouring the internet for many signals on what companies are showing up on many different filters, largely around consumer feedback, largely around enterprise feedback, and largely around recruiting. Those are 3 signals that you are looking for. And there is software that tracks that. There are people who sit and track that. And then based on that, someone cold calls them and you say, you know what, I am from ABC. We have so much money. We can help you this. We have invested in ABCD companies. Can we meet? And that's how sourcing happens for the business. After that, you have to apply your judgment and say whether it makes sense for me or not. So that's the first part of our investment journey, or when you think about deconstructing. The crucial phase begins then, which is the evaluation, the diligence, the term sheet, and the execution. And post that, it's a 5 to 7 year journey with the company. And many people don't pay enough importance to that part. What happens is the trajectory of many companies changes just because they get capital, because they're very smart entrepreneurs who know how to utilize capital well. But there are many other companies where the fate changes not just because they got capital, but because using that capital and along with the partner that they got, which is the fund, they're able to make two, three, four very smart hires who then help in changing the direction of the company. So the founder may be capable, but may be a very strong product person who does not know sales or marketing or something else. And that's the key hiring gaps that need to be filled along. So that 5 year journey is equally as important. The first 2, 3 years of that are very important because that you fix the back end, you make sure proper hiring is done, you nudge the direction of the company based on where the big market opportunities are. You set the goals higher usually, and so on and so forth. So that many things which go. And at the end of it, you still need to exit the company, which is the hardest job in our business. You've done all this, the company's gotten to a certain stage, and where India has done a horrible job so far, and things have improved in the last 1 year or so. India has done a horrible job. Indian investors like us have done a horrible job is in exiting. And that's the single largest complaint Indian limited partners have against what Indian investors have done so far is not return enough money back. And that's an important one. And it's one because people have not focused on it. Second, the Indian capital markets have not been as open to so-called venture companies. It's beginning to change as some new IPOs are beginning to come to the market. I think that mindset will change. The ability for the Indian capital markets to value loss-making, high-growth companies is setting in. It will happen in the next couple of quarters. And all this will change as we go along. But that's finally the most important part of investor's journey, which is make sure that you return the money back to the investor with some nice returns. That's overall the investment journey. The only question that you asked, which I did not answer, this is a very, very long answer, was when we look at founders, what do we look for? Because it's something which there's no formula for it. There is no playbook for it. I think it's a little bit of pattern matching. You look at someone and say, how does this person compare with some other founders that we've dealt with in the past? The good founders displayed certain characteristics. Are these people displaying the same characteristics or not? And based on that, you make some kind of subjective assessment. But there are some hard things that you can obviously check, which is how strong is their understanding of the markets that they're operating in, and how does that compare to other founders in the same business? Are they showing a better understanding of the market? What have they achieved to date? I mean, there's a report card of that. Have they done anything worthwhile so far? Desire and ambition. Somebody may say, I have a 100 crore business. You know what? In the next 5 years, I'll get to 300 crores. And there's somebody else who says, you know what? I have a 100 crore business. I want to get to 2,000 crores in the next 3 years. And that's a very different level of desire and ambition. And within that, the desire and ambition backed with some conviction and some skills is what we look for. Another important skill we look for is how well they steward capital. So there are founders who raise a lot of money, burn a lot of money, and are chasing a very large market opportunity without thinking about profitability. And therefore, you have to keep diluting and keep raising money. Many venture funds love that. For us, we pay a lot of importance to how people have spent the money they've raised so far, which is what we call stewardship of capital. And as I said, a very important characteristic always is the quality of team that you're building around you. No business is built by a single person. And are you showing signs of attracting and retaining at least a few very good people around you? Because if you haven't done that in the past, just because a venture capital firm comes and funds you, you'll not be able to do it in the future. There's something about the ability of a founder to communicate his vision and desires to somebody and attract them to come and join them at not a great compensation, but with some promise of equity and so on, is a ability that will take them very far. And finally, are they open to learn? There are people who are very good but very stubborn, but we also know that the world around us keeps changing, and therefore a good founder will have to react, especially in today's environment, because capital flows in big quantities in one direction, that means you have to change your track because your competition suddenly got a lot of funding. You may need to kind of change your market a little bit. But if you're stubborn and you want to run into that storm, uh, it's going to be tough. So you cannot be super stubborn about saying, hey, you know what, I started with this vision, I want to just execute this vision and nothing else. That may not work. So you have to be open to change given how quickly things change around us. So there's no list of characteristics, but these are some of the things that you look for in founders when you are working with them or partnering with them.
Yeah, so I'm sure you are doing a lot of your household shopping. Since you focus mostly on the consumer side, so help Rashmi in all those, the shopping list, as they say, right? We should have bought Apple stock instead of Apple phone, and you should have bought Tesla stock instead of the Tesla car. Uh, Now let's switch a little bit, and we talk about public versus private, right? I mean, and I was just looking at some of the data in US, and I don't have much data for the Indian market. The median public market equivalent return, and this is I'm quoting from Michael Mobashin's one of the report. Return has been about 1.2, basically it's 20% better than the public market for buyout funds and one for venture. So basically, it's not that the private markets have done much better than public markets. What do you How do you look at I'm sure you do your own investing as well, and we'll come to that later on your own personal investing. So that's one thing I want to talk about. Secondly, since our the podcast is named as Breaking Investment Stereotypes, what are the stereotypes in your space in investing in private space, which uh, which is there, and you would like to break here and talk about?
Um, hmm. So first, I can talk about the venture space and returns in the venture space compared to the public markets. I don't know about the growth equity side. And the important fact about the venture space is that returns are concentrated with the best funds.
Yeah.
So if
So
you look at
dispersion is too high, basically.
you look at the top decile
Yeah.
funds, they deliver much superior returns compared to bottom 50% funds or even the next 90% funds. So it's too high.
And so the next 90% show those top 10% and get the money. Me too
That's
kind
so
of funds.
people who are not able to get into the top 10% funds have to invest in venture funds. They go into the next 10 and the next 10 and so. And at any point in time, new funds get created because there's a promise of delivering something or trying to break into the top decile. So, I know the exact results of Sequoia funds, and they are just outstanding over the last 50 years. And I know of some of the other high quality names which have done extremely well. So, I think that will stay as it is because as you get stronger and stronger in this business, the flywheel effects comes into play. The better entrepreneurs want to work with the better funds. More capital comes into the better funds. More people want to join the better funds. The executives of or good quality professionals want to join firms funded by better firms and so on and so forth. It keeps working in that direction, and it's getting stronger. While we all keep saying capital is a commodity, which in I would say as you get to the larger and larger sized investments, it does begin to look like a commodity. But at the early stage, when companies are looking for direction, brand, recognition, etc., there's a disproportionate advantage that some of the early stage funds have.
Okay. So and when we talk, so let's talk about these stereotypes as well. I mean, any thing you want to talk about that?
Sure. There are quite a few. I would say first is if you look from the outside, venture investing looks all about spray and pray. And I don't think it is because I've sat inside the meeting room over 13, 14 years, and you know how a high quality venture fund operates. You do think about deeply about neighborhoods. You do deeply think about teams and quality of teams. You have a lot of data across your portfolio. You've invested in hundreds of companies and you're getting data from all of them. And therefore, there's a lot of intelligence around what's likely to work and what's not likely to work. So while it may look like spray and pray, it's a lot of thoughtful investing. The challenge is when you go at a very early stage, there's so many variables and so many uncertainties that you will get many decisions wrong. But do not mistake that for spray and pray. You are thinking and investing, you will still get 30, 40 investments completely wrong. And only the top 20% investments may determine most of your returns. But even to get that right and get that right at big scale requires a lot of intelligent thinking behind that. So that's one. Um, I I spoke, I referred to that this early on, but a lot of people believe that at very early stage, just pick a great founder and that's it. I think that's not just it. You have to pick a great founder. You have to know that the great founder is in a reasonable market, if not the best market, and has the ability to navigate towards a great market. For the magic to happen, as I said, you have to navigate a great founder towards a great market. And most great founders navigate themselves towards it, but the direction required, people required, team building required. There's a lot of things that need to go along with it to make sure that happens. And sometimes it's also about making sure that more capital comes towards that great founder versus capital going elsewhere. Because a great founder cannot fight a competitor who's very, very well funded, much better funded than them. So that's a stereotype saying just find the great founder and life is good. That doesn't work. Another thing which has changed in terms of stereotypes in venture investing over the last, I would say, decade is that it's a young person's game. That's a stereotype. It's not. So even when I joined Sequoia, the belief was back young people. And they will create world-beating products, world-beating companies, and so on and so forth. And this was this is exactly on the time when Facebook happened and so on. But as you look around after that, the wave after 2010 to 2015 to 20 has largely been a SaaS wave. And that wave has largely been founded by very experienced entrepreneurs. And most of them would be not the 25-year-olds, but at least the 35-year-olds. And there's been enough research which has gone on to prove that age is not a big determinant of success as far as the founding team goes. It's about how much you know and so on. So, of course, you're starting Snapchat or Instagram, you need to be very young. But if you're starting a Salesforce or a Zoom, you don't need to be that young because you need to understand enterprise sales. So age is less important a factor than it was a decade ago. And that also goes for investors. I would say for investing in consumer internet companies, it's great to have some very young investors because they understand the product and the market much better than the older investors. When it comes to SaaS, it comes to some other consumer goods, etc., experienced investors understand the market better. So age and the thesis around it is something which is no longer relevant. And I would say those are some of the key stereotypes that I've encountered, which are not necessarily true.
Yeah, and then particularly the age part is very music to my ears. I completely believe in that. And you're right? I mean, it's basically depends on the industry, what kind of product you're creating. I mean, if you're creating a product which is for Gen Z, of course, a person who's from that age, it will be much better in understanding what they need, right? Like for a gaming, I mean, I don't play any games. I don't know about you, but a young guy will probably build a better gaming company than probably any of the guys with an experience. Uh, so let's, I mean, we've spoken about the investing journey and all, and both you and me have been very bullish on India, definitely for the next decade or so, and we already seeing about whatever 30, 40, 50 billion dollar companies in the private side, which is there right now, ready to go to the IPO stage, probably either US or here. But if you look at next 10 years, what are the, and I do believe that there will be at least 100 to 200 more such companies which will get created out of India. But what are if you want to talk about a trend, I mean, industry wise, I mean, in any particular industry you see where, you think that India will have more chance of success? I mean, like, for example, SaaS, you spoke about, that is one area which I believe, I think probably will create more bigger companies, global companies out there. But any other trends you're seeing?
I think the two trends will not dramatically change. One will be based on domestic consumption, and one will be based on software being made in India for the world. Now, what is yet to be seen is will the Indian companies who are making consumer goods for India goods or services for India, we'll be able to export it successfully outside India for that market also to get created. That's yet to be proven, but I suspect given the talent that we have in India, the kind of engineering talent, this is likely to happen as well. So I'll be super bullish on these 2 or 3 mega trends. And I think the 100 number is will certainly happen. It's not a matter of will it happen. I think the big question is, will this be all billion-dollar companies, or will we have some very large companies? And that will be a function of how India's economy grows. If you think about the US, the venture capital business started there in the 1970s. Even then, the per capita income was more than $10,000. And by the time it started taking off in 2000, when this whole internet boom happened, the per capita was about $35,000 to $40,000. In China, when the real boom happened in 2000, between 5 and 10, the per capita was between 5 to 7,000, in that range. Maybe 3 to 5,000 range. India is still behind. So the funny fact is, in the US, purchasing power came first. The internet and the enabling infrastructure came later. In China, the purchasing power and the internet and enabling factors came together. In India, the internet and the enabling factors have come first, and the purchasing power we are waiting for. So once the purchasing power comes, and it will come gradually over the next 5-7 years, we think there'll be an explosion, because the consumer is used to it. He just doesn't have the money. He knows how to buy. He knows what to do. The infrastructure is good. Payments is good. Logistics is good. Everything is working smoothly. Just the money has to come, and the money is going to come very soon.
Yeah, I think India has an income problem, right? I mean,
absolutely.
We don't have. I mean, people say people don't pay tax. Well, I said people don't have money to pay tax. I mean, people need to earn to pay tax, right? I mean, ultimately, the consumer set we all are going after is all those, out of those 6 crore tax return filers, there were 3 crore people who pay tax. Those are the actual consumers. So forget all those 120 crore, 130 crore, whatever population we have, right?
Okay. So I see, if you think about what is required for a successful businesses to be created in the internet economy. First, bunch of high quality engineers. Second, a large domestic consumption economy. And third, basic infrastructure. When I say basic infrastructure, it's both internet as well as other infrastructure, because logistics is important. India already has a bunch of high quality engineers, the largest numbers that produce anywhere in the world. We have the infrastructure already in place. And the large domestic economy that we spoke about is large, but not large on a per capita basis. And as soon as that changes, we will be unmatched. So if you think about where are the largest venture ecosystems created in the world, there are only 2 locations where it's really vibrant right now, which is the US and China, which meet all the 3 criteria. India will only be the 3rd country where all these 3 criteria will be met. Some countries have high GDP but no engineers. Some people have engineers but no GDP, and so on. So you have to be super optimistic about India and the internet economy over the next 10-15 years. As the convergence of these 3 will happen, the 100 may seem like a small number. But I think the real question is to say the pace at which the GDP per capita will grow will determine the size of these outcomes. A $1 billion company in 5 years' time may not look that exciting. You want $10 billion companies then. And in 10 years' time, you want the $50 billion companies. So how many $50 billion companies will be created in 2030 is the real question. Will it be 10? Will it be 20? Will it be 30? And that will decide the fate of the venture industry in India. Will it become really big and successful as US and China? Or will we be okay and mediocre success will happen because there are $101 billion companies?
And what's your take? How many $50 billion company will be there in 2030?
That's a very tough question. I haven't put my thought to it, but I would say there should be at least 10 to 15. We'll be disappointed if they're not at least that many.
Okay. By the way, talking about engineering talent, I've talking to somebody and he met a guy here in Hong Kong, and they were going through some presentation, and apparently that presentation was actually made by a guy sitting in Jalandhar. So he had a guy sitting there in a small town, making the presentation for the guy, and this guy was actually not even Indian. So talking about talent and in small towns across. I think that's going to be the driving power. And talking about the 50 $100 billion company, I mean, and we probably more talked about the domestic consumption, but the chance of Indian company becoming a truly global company like a Zoom, I mean, Zoom could have started anywhere, right? You don't need to start in, I mean, I have a great example is Postman probably doing some great work, which I keep hearing about, from India. Um, I think that's where probably a truly global business is where probably we have more chance of becoming a 50 or $100 billion company than a pure domestic consumption, which may take longer time.
True. Actually, if you think about most of the US companies or the big successful new economy companies that have been created, uh, most of them have gone well outside the US. They're doing business all around the world. And there's not much reason that they cannot be created outside the US. Now, something like an Amazon needed to be created in the US because you need to have a good domestic market before you go outside. You need to have some size before you can say, I'll sell in India or wherever else. But there are many other businesses which could have been just born anywhere. So we should be super optimistic about software exports from India, products, less services.
We spoke about Bhilai initially, and where I know that you do quite a decent work on the philanthropy side. You associated with Ashoka. We both run a trust called Bhilai Education Charitable Trust. Do you want to let's speak on that? About your what's your thought process behind that? How do you approach that?
So I think the fundamental reason for all of this is uh, you get a lot of satisfaction from doing something for others. We've all, at least till you hit the age of 40, you're thinking about yourself and securing your so-called future. But once you do that, you start looking back and saying, what else have I done? Have I done anything for anybody else, or am I just been super selfish? And the answer usually is very selfish. And therefore, you start changing that, saying, what can I do? When you look back at where can I contribute and so on. And you do it just, I say, it gives you immense satisfaction to even do something for someone. Um, and unfortunately, we don't have the luxury of spending a lot of time because we're busy with our professions and we made commitments and taken capital from other people to say that we devote our entire time to doing that. In which case, what works out better is to say, let me give a small amount of capital and small amount of time and try to make the best out of it. And that's what I've been doing over the last 10 years or so. Funnily, I had to sit through an interview after a very long time. This interview was for a school admission for my kid. And after a long time, somebody asked me to talk about my, if you will, bio data or achievements in life. And as I thought about how to make them feel good about what I have done, actually it wasn't about IIT or IIM or McKinsey or whatever else. It was about the social work that I have been doing, and that's something which I felt the most proud of expressing. And then you sit back and say, if that is what gives you most joy, satisfaction, pride, you should be doing more of it.
Yep, I mean, you definitely you put it very right. And only on those moments you actually figure out what is the best thing which has happened to you. And probably a lot of things we overvalue in life which actually shouldn't be, and what a lot of things we undervalue in life which actually we should be valuing more. uh, so on the other way to give back, when I always believed in that, is actually mentoring people, people around us. You and then you had such a great career so far. What will be your advice to young entrepreneurs who are looking to make it big, since you deal with entrepreneurs, or to budding individuals who are looking to make a career in the investing world?
Um, I don't know if there's one advice for everyone. There is different things that work well for different people. Uh, but if you were to give simple advice to everyone, I would just say, Uh, Work hard, give it your best. Never should you have the regret that I did not achieve this because I did not give it my best. That's the worst feeling to have. You may not be capable enough of achieving something, and that's okay to live with, but it's not okay to live with the fact that I did not do my best and therefore did not get it.
Yeah. I would also add that, a lot of times people think a lot and actually don't do it. So just do it. I think that is also super important. I mean, you got to try out. There is, I mean, uh, if you don't try, you don't know what is it. Secondly, I mean, people think about so many negatives, right? What will happen, this and that, whether will I get a job or not. I think life always get better. So yeah, the negatives which you think of are actually not at all negative. A lot of people, and I'm sure things are changing back home as well, where which is very prominent in, say, Silicon Valley, which is, your failure is actually your success as well. People treat that is an important criteria for you, that you would have failed in something so that you learn something. I don't know whether you agree with that or not.
Yeah, absolutely. And I think when you're young, you don't think about these things. As you age, you start thinking about some of these things as to what is really important for you. And it may be different things for different people, but finally, what gives you happiness? And as I think about it, sitting with a few friends, having a glass of something you like, and having conversations about life in general is what gives you maximum pleasure. Listening to some music along with it. And if that's what it is, then you need to be in a position where you have some people who trust you and like your company because you've done the right things by them and you just enjoy each other's company. And so they should be like-minded. And what are you doing to be in that place? So which has implications of saying do not do things the wrong way that upsets people around you. Do not have a high ego, which again upsets everybody around you. Manage some of those things in life, irrespective of how successful or not so successful you are. If you manage these, I think you achieve what you want. But be clear. Some people may say, I don't care about others. I just want to make money. Screw others. I don't want friends around me. I want more capital, more money. And if that's subjective, that's a different approach to life.
Okay. We are coming towards the end of our conversation. So probably some few rapid fire questions I have for you. What's your favorite book?
Uh, I uh, Actually just completed reading William Dalrymple's series of books, The Anarchy, The White Mughal, The Last Mughal, The White Mughal. I love these books. So I don't know if there's one favorite book. You read something, you love it, and that stays in memory. So that series right now is fresh.
Yeah, the Anarch is actually good. I mean, it actually is a little depressing as well when you read that how much we've done to ourselves. Life Idol.
Um, um, uh, I there's a life idol. There are people that you like, and I don't know if there's one single person. Very near home, there is somebody like an Ashish Dhawan who has had a much better career than I've had and has done extremely well. I think very highly of him. So he's near his our age and has done much better and bigger things than what we've done, and we would love to get into what his shoes. Uh, if you think of uh, there are many entrepreneurs that you respect and think really well of, um, and within those that have had non-controversial careers are the ones that I like more because it just feels like you put your head down and done a great job. So it's less of a Zuckerberg and more of uh, uh, I would I would say Sergey and Larry.
Yeah. In Investing Idol.
Um, I think I would say Mike Moritz of Require Capital.
Hmm. And lastly, where can we expect Abhay Pandey to be 10 years later?
Hopefully doing the same thing, much better, because we made a more than 10-year commitment to our LPs. So I'm not going anywhere.
Thanks for that confirmation. And with that, we come to the end of our conversation. I really enjoyed our conversation. We've had many such conversations, in with those classes of whatever we like. But I think this is different, So and this is this is definitely different, interesting. So thanks a lot for joining here.
Absolutely, my pleasure. Yeah, the fact that it's being recorded puts undue pressure to make sure you're not saying anything wrong or inappropriate. But it's been a pleasure. Thank you.
Yeah, thanks a lot.